In total, government spending and taxes reflect economic decisions made by our elected officials. These decisions directly and indirectly influence the total U.S. economy, not just the 17 to 20% of GDP that represents direct government spending. The sources and uses of government spending is referred to as public finance. This lecture reviews a number of different aspects of public finance. We're going to use a circular flow diagram to illustrate how the allocation of resources is affected by government's revenue and expenditure decisions. We'll identify the main categories of government spending and the main sources of government revenue at the federal, state, and local level. We'll describe the differences between marginal and average tax rates. Then towards the end, we'll summarize the different philosophies regarding the distribution of a nation's tax burden and discuss the probable incidence of U.S. taxes and how the distribution of income between rich and poor is affected by government taxes, transfers, and spending. This is quite a bit of ground to cover, but the government influences most aspects of the economy. Previous lectures showed that households and businesses decide what will be made, who will produce it, and who will consume it. It left the impression that the market system was the sole decider of how resources get allocated and who gets the income. Not exactly. The government also plays a very strong role in the economy, as they purchase goods in the marketplace, are a significant employer, and tax households and businesses. By their taxing and spending ability, the government has the unique ability to transfer income. Government is in the middle of the circular flow of revenue and costs between the resource market, land, labor, capital, and entrepreneurial ability, and the product market. Further, they are in the middle of spending and taxes between businesses and households. The extent of government involvement is always a topic of debate. However, the government has a serious influence over interest rates, a key enabler of private and public investment. The portion of revenue, taxes, removed from the private economy, and the amount of those taxes they put back into the economy through their own spending. Importantly, the federal government controls the money supply and can borrow money when spending is greater than tax revenue. This chart represents the total circular flow of the U.S. economy between the government, businesses, and households. It will be covered extensively in the macroeconomics class. However, I want to touch upon a couple of points to give you some examples of the government's role in the economy. Let's look at two of them. Point 11 on the left side of the chart, represented by the blue line, represents the tax revenue the government collects from businesses. The red line, point 10, shows that the government also spends money and buys goods and services from business. The same is true with households on the right of the graph. The government collects payroll, income, and investment taxes from households, point 12, then provides goods and services to households, point 9, by providing Medicare and Medicaid benefits, Social Security payments to retired households, and takes care of roads and bridges. Well, and importantly, provides sovereignty protection to all Americans. There are two types of government expenditures: government direct purchases, which are classified as exhaustive, in that they actually consume resources. Think of military purchases. And transfer payments, like Social Security, Medicare, welfare payments, benefits for military veterans, and unemployment benefits. These are classified as non-exhaustive due to the fact that the original resources were already consumed and there is no direct consumption of resources during the transfer. Okay, so let's just pick Social Security and Medicare. Employers and employees provide those payments initially to the government through the payroll tax deduction, and then later collect those downstream once they retire. So there is just a transfer of the income and not an exhaustive or direct consumption of resources. So you need to understand the difference between exhaustive and non-exhaustive in terms of government finance. In total, all government entities in the United States spent $6.1 trillion in 2016. It's a lot of money. So today, it means that tax revenues need to be this high, or the government must borrow money. Government transfers make up 42.8% of total spending, up from 37.5% in 2008. The data module in this particular, the data section in this particular module contains the charts with the latest information available. At times, government borrowing can be a positive decision. First off, borrowing allows the government to spend more money than it takes in via taxes. Borrowing, or budget deficit spending, can help the economy during a downturn. The government can spend to maintain growth or keep the economy from falling too deep into a recession. A very positive impact. Increased spending by the government during 2009 and 2010 certainly helped stabilize the U.S. economy. Are there negative impacts? Yes. The more governments borrow, the more interest on the debt continues to grow. Likewise, there could be what is called a crowding out effect of private firms during expansion periods. Right, so you want to think of the government and private industry going into the borrowing market, okay, and trying to issue notes to borrow money. Well, the government, being the low risk source of debt in expansion times and given a fixed amount of lending resources, could crowd out private firms during expansion periods. So, given that funds are not unlimited, $1 billion borrowed by the government at a lower risk to improve roads and infrastructures may not be available for the private development of new technology, crowding out However, during an economic downturn, borrowing does not crowd out private investment. The total loanable funds pool is not used due to a reluctance to invest by private companies when times are a little tougher. Let's go a little deeper into federal spending and federal revenues. Where's the money spent? 4 spending areas really stand out. On the left pie chart, we can see that pensions and income security make up 37% of spending. This group is primarily made up of Social Security and unemployment benefits. Healthcare spending is 23%, a very large number that includes Medicare and Medicaid benefits. National defense at 19% and interest on the public debt from all the years of deficit spending is at 6%. Both spending and taxes have increased through 2016. Unfortunately, the budget deficit has grown as well. Annual budget deficits have been a U.S. problem for the past 15 years. Americans like deficits, I think. Art Buck, a conservative Canadian politician, explained why. In my way of thinking, he explained this best. Reduce the deficit? I wish we would. I doubt we really will. It hurts too good. So, both through Democratic and Republican administrations, we have done deficit spending. I think the last person to actually run a budget surplus where taxes were greater than spending, you have to go as far back as Bill Clinton. We cover a lot of that in the macroeconomics class, but suffice it to say that 2016 expenditures were at 4.1 or 4.2 trillion. Taxes were at 3.5 trillion. Didn't collect enough taxes to make up for the expenditures, so the deficit was $697 billion in 2016. There are many that actually believe the taxes in the United States are too high. This is a kind of a normative economic statement, meaning what we would like to believe, okay? Facts are, overall U.S. tax revenue as a percent of GDP is among the lowest in the world in the United States. Canada, the UK, Germany, France, Italy, and Japan all have higher rates than we do. Mexico and Korea have lower rates than the United States. What are the ways that the federal government collects tax revenue? On the right pie chart, we can see that personal income taxes are the largest source of revenue at 46%. Second is the payroll tax, Social Security and Medicare levies. Third is the corporate income tax. Just as a frame of reference, the federal government employs about 2 million people to perform all federal functions. National defense, the post office, and healthcare are the largest employee groups. The personal income tax is the kingpin of the federal tax system. The tax is levied on taxable income, that is the income after deductions and exemptions, such as mortgage payments, unincorporated business expenses, charitable contributions, and contributions to health savings accounts. The personal income tax is progressive, meaning the higher the income, the more that is proportionately taken out in taxes. This proportion is called the marginal tax rate. We'll look closer at the marginal tax rate in the next slide. Payroll taxes are collected to fund two compulsory federal programs, Social Security and Medicare. These taxes are collected as a percent of wages up to $110,100. Employers and employees pay approximately 8% each on these wages. So for someone that earns $110,100, employers pay $8,000 and employees pay $8,000 for a total of $16,000 of payroll tax. Corporate income taxes are levied on incorporated businesses after they deduct all expenses. For most corporations, the tax rate is 35%. Excise taxes are applied on a per unit sold basis. Thus, an excise tax on gasoline is typically leveled on a per gallon basis. The same for a carton of cigarettes in terms of tobacco. Before we move to how states and local entities spend in tax, let's take a look at the federal marginal tax rate. Here, we have a tax revenue table for a married couple filing a joint return. Down the left-hand side, you see the taxable income brackets. In the next column is the marginal tax rate percentage. You can see for each category as you go up the rows and up the income, that marginal tax rate increases to a high of 39.6% on the income that's made above $450,000 a year. Okay, you can see that on the income from $17,851 to $72,500, the marginal tax is applied at 15% for a total maximum tax of $99.83. The next highest group get a higher marginal tax rate of 25% for a total maximum tax of $28,458. The progressive nature of the federal tax system applies these higher rates to higher brackets of income. The increasing marginal rates lead to an increasing average, a progressive system. The average tax rate is shown in the final column, with 28% being the maximum average tax rate that married couples currently pay. So here you need to understand the difference between the marginal rate, which is very progressive. It just leads to the simple calculation of an average tax rate going up to 28%. The key is the progressive nature of the marginal tax rate. States spend the largest portion of their tax revenue on education and public welfare. 2015 is the latest data available, with education at 29% of expenditures and welfare 28%. You can see the percentages of 2015 down at the bottom. I've added those in. The percentages inside of the pie charts reflect 2011. I wanted to update the data a little farther than the book shows in 2011, so I've updated this through 2015. Okay. The data chart in the module has complete detail up to date on what this information is. The largest source of state-generated revenue are sales and personal income taxes. Sales generated 47% of revenue, and income taxes 36% of revenue in 2015. It needs to be pointed out that the federal government also transfers a significant portion of money so that states can support programs at a local level. In 2015, the federal government transferred $605 billion to support local programs. Without this transfer, state governments would have to curtail spending. So you can see here on the left, state expenditures in 2011, $1.6 trillion. Revenues were $758 billion. Well, how do they make up the difference? Well, most of that difference is made up by federal transfers. Okay, that's why the title of this chart is Without Federal Transfer. So without this type of federal transfer, and given that a lot of states, if not the majority, need to balance their budgets every year, they would, without that transfer from the federal government, the states would just have to reduce spending or increase tax revenue in order to balance their budgets. In total, the states do not have the latitude to run large deficits. Local governments, like cities and municipalities within states, spend most of their money on education. At 44%, welfare and hospitals at 12%, public safety and housing. Okay, so education here is the biggest portion. The next biggest portion is the welfare, health, and hospitals. The preponderance of revenues generated from property tax. So it's a little different from states and certainly the federal government, but local entities get most of their tax revenue by levying property taxes and a little bit from sales and excise taxes. Local governments employ the most individuals at 10.6 million people. Okay, so that's where all the employment's at, down at the local level. As with states, local governments get transfers from the federal government and the state to balance their budgets. That's how this money gets down to the local level. In summary, 62% of all government spending is done at the state and local level. The federal government only makes up 38% of expenditures. Okay, so the state and local, as you can see at the bottom, 62% of all expenditures. I want to go back to the state chart for a moment to make a point. Due to the fact that nearly half of the state revenue is raised through sales taxes, you can conclude that state sales taxes are slightly regressive. Why? People who are wealthy and people with lower incomes, they can only purchase so many goods as individuals, whether they have high income or low income. Yet for lower income people, daily purchases consume a higher proportion of their income. Thus, the taxes are referred to as regressive because so much of it is made up of sales and excise taxes that basically make up daily transactions. Apportioning the tax burden. Who is going to pay and why is a key decision in any economy. Who should pay the tax? Tax apportionment is an important piece of public policy, and certainly an important piece of the public debate that's been going on for quite some time. Oliver Wendell Holmes said that we have to pay a tax to have a functioning government, to do certain things for us that we cannot do ourselves. He also said that taxes are the price we pay for civilization. These days, many members of Congress may not agree with that. As the book says, many people would prefer to obtain government services without paying for them. Not realistic. Practically speaking, there are people that are worried about the size of the tax level, how the taxes get distributed, and the cost that taxes impose on society. That is a valid debate. Getting something for nothing? No, that's not a valid debate. The fact that we pay some of the low in the U.S., the fact that we pay some of the lowest taxes in the globe is not relevant to the people that don't like taxes. They worry that taxes discourage beneficial economic activity. Warren Buffett fundamentally disagrees. Buffett has consistently maintained that he never put the tax implications of a deal ahead of the basic economics of the deal. Okay, so given that as background on who should pay the tax, there are two schools of thought. First school of thought is the benefits received principle. The principle asserts that households should purchase the goods and services of government in the same way they buy other commodities. Those who benefit the most should pay the most. Sounds logical. And some taxes are actually applied this way. Gasoline taxes are levied to pay for highway construction and repairs. The people who drive the automobiles and use the roads or get the benefits pay the tax. Yet, how would you pay for national defense? Only when your neighborhood was under attack? Would you pay for the fire department after your house was on fire? Highly difficult policies to implement, I think that you would agree. Further, you can't ask welfare recipients to pay for their welfare. They're getting the welfare. So, abilities to pay, or the benefits received principle is a interesting theory. Overall, it's difficult to measure who is really getting the benefit, and certainly the timing of the difference between collecting the tax and the actual event, you can see does have some logical difficulty. The second method, and what most economies implement, is the ability to pay principle. This principle asserts that the tax burden should be apportioned according to the taxpayer's income and wealth. Ability to pay is obviously easier to measure and collect. The United States basically collects most of their taxes through the ability to pay principal and the ability to pay method. Okay, so it's really the bottom measure that is used in the United States. Want to recap so you understand the three different types of apportioning the tax burden. There are three types. The first is the progressive tax, where the average tax rate increases as income increases. I think we talked about that relative to the U.S. income tax. A regressive tax, where a fixed percentage tax on a purchase, like a sales tax, has a greater impact on households with lower incomes than it does on households with higher incomes. And we talked about why. The lower income households purchase food and other consumables in a higher proportion than wealthier households. The Social Security tax is also regressive due to the cap on income at $110,100. Workers receiving a salary above this amount pay no Social Security tax. Medicare payments are not capped. The taxes are also regressive because they're just applied to wages and salaries and not to investment income or capital gains. Property taxes on buildings are regressive because owners add the tax to rent and add the tax to rent payers. And property taxes on households take a higher proportion of low-income households than higher-income households. So you really want to understand these two, especially as it pertains to a quiz or a tax, in understanding why a tax is progressive or why a tax is regressive. A corporate tax has a flat rate of 35%. You're a big corporation, you're a small corporation, don't matter. It's a flat rate of 35%. This tax is viewed as proportional by some due to the fact that it's the same for all companies. However, it could be viewed as somewhat regressive if workers receive lower wages or companies move to other countries that have lower tax rates than the United States. But in the main, proportional tax is the corporate tax, unless some jockeying goes around, and then you could view it as slightly regressive. Just to conclude, we can say that the federal tax system is progressive. Local and state structures are largely regressive. Combined, we can say that the overall total U.S. tax system is slightly progressive and more progressive than other rich countries. We are, the United States, due to the fact that countries like Germany, Canada, Japan, Sweden, and the United Kingdom use regressive sales and value-added taxes to generate a larger portion of their revenue. So we're different than most of the other developed economies. This chart is a nice summary of the type of tax and who actually pays. I would take the time to go back into the PowerPoint deck, take a look at this chart and understand it. It's a nice summary to, let's say, refresh your thinking for any quiz and test review. We close the tax lecture by reviewing a last word piece on income redistribution, a highly debated topic. Thus, it's worth spending a minute on the facts. Tax and spending are two different events. You can tax the rich, but you don't have to spend it on the poor. You can spend it on goods and services that benefit the rich. Does the United States do this? No. A 2007 study by a nonpartisan tax foundation shows the U.S. government does transfer a large amount of income from those with high income to those with low incomes through welfare, subsidized health care, public education, and jobs program spending. We'll see on the final graph, the bottom 40% of income levels received more government spending than they paid in taxes. The top 40% paid more in taxes than they received in government spending. Conclusion: U.S. tax and spending policies do redistribute income. It's just a fact. Finally, this is a graph of U.S. income by quintile, or the 5 major groups, from the bottom 20% to the top 20%. We can see on this graph that taxes paid, the orange bar, by the lower two groups is substantially less than spending received, green bar. The opposite is true for the top two quintiles. We started this lecture by indicating the government played a significant role in the economy. You should understand this a little more clearly now in terms of their role in the middle of both the ability to tax, to spend where they would like as a policy, and importantly, the ability to borrow to make up the difference between what they collect in tax revenue and what they spend.